Today, the bears have it. Hello again, it's Martin North from Digital Finance Analytics. Well, that is post covering finance and prop news with a distinctively Australian flavour. Well, I'm afraid as expected, US equities tumbled on Monday, with the S&P 500 confirming that it is in a bear market, thanks to expected aggressive interest rate hikes from the Federal Reserve that would push the economy into a recession. Markets have been under pressure this year as climbing prices, including a jump in oil prices, due in part to the war in Ukraine, have put the Fed on track to take strong actions to tighten its monetary policy, such as interest rate hikes. And the Fed, of course, is scheduled to make its next policy announcement on Wednesday, and investors will be highly focused on the clues for how aggressive the central bank intends to be in raising rates, and of course whether it's going to change its quantitative tightening program. And of course it's here worth reflecting on the fact that market liquidity is now a problem, and with rates falling, more margin calls are meaning people having to sell assets to prop themselves up. So it's very timely that tonight my live discussion will be with Robbie Barwick from the Citizens Party, and we're going to discuss some of the broader issues. For example, what does this mean for financial stability, for deposit bail-in, and even for investment in infrastructure and how that should be played out? So join us at 8 p.m. Sydney for what will be a riveting discussion, of course assuming that New South Wales keeps the power on. Now, the latest pickup in consumer prices in the US and the inflation expectations will probably spur the Federal Reserve officials to consider the biggest interest rate hike since 1994 when they meet this week. Remember that Chairman Jerome Powell previously signalled a smaller move was the likely outcome. But in fact, the benchmark S&P index has fallen for 4 straight days, with the index now down more than 20% from its most recent record closing high, to confirm a bear market which began on January the 3rd. That's if you use the standard definition of what a bear market is. All the major S&P sectors were sharply lower, with only about 10 components of the S&P 500 in positive territory on the day. High-growth market heavyweights such as Apple, Microsoft and Amazon were some of the biggest drags on the S&P 500. And against the backdrop of more aggressive Fed moves, travel and leisure, which are vulnerable to a weaker consumer and economy, ended the day deep in the red. Caesars Entertainment, American Airlines, Norwegian Cruise Lines, and Booking Holdings were all down sharply. Energy, meanwhile, struggled to cut losses, even as oil prices turned positive, despite concerns that rising COVID-19 cases in China could slow energy demand. Pioneer Natural Resources, Phillips 66 and ConocoPhillips were among the biggest decliners in the sector. And Tesla fell more than 7% to lead the decline in consumer discretionary amid worries about the impact of the potential lockdown measures in Beijing following that spike in COVID-19 cases. The yield on the benchmark 10-year US Treasury note hit 3.44%. That's the highest level since April 2011. And growth stocks, of course, are more likely to see their earnings suffer in a rising interest rate environment. In addition, the 2-year versus 10-year US Treasury yield curve briefly inverted for the first time since April, which many in the market see as a reliable signal that a recession could be coming in the next year or so. Now, as I discussed in an earlier post, the hotter-than-expected consumer price index from last Friday did prompt traders to price in a total of 175 basis points in interest rate hikes by September. And Goldman Sachs late on Monday says it now expects 75 basis point increases in both June and July. The FOMC is likely to respond to the firmer inflation print and the rising long-term inflation expectations with a resolutely hawkish message at the June meeting. In addition to the 50 basis point rate hike it is set to deliver, Goldman Sachs said in a note. And Nomura Holdings also shifted on Monday to forecast 75 basis point hikes this week and at the Fed's meeting in late July. And JP Morgan Chase also went to 75 basis points at this week's meeting, joining Barclays and Jefferies, who modified their calls last Friday to the larger increase. All up, expectations for a 75 basis point hike at the June meeting jumped to 96% late on Monday from 30% earlier in the day, according to CME's FedWatch. The market has been trying to rally around the idea that inflation has peaked and that the Fed would not have to be more aggressive, said Ross Mayfield, investment strategy analyst at Baird in Louisville, Kentucky. That story fell apart on Friday with the CPI report showing broad inflation being entrenched everywhere you look. So the Dow Jones Industrial Average fell 2.8%, the Nasdaq was down 4.7%, and the S&P 500 down 3.8%, taking its total losses since its recent peak above the 20% bear market territory. And that's a new low for the year, of course. The Nasdaq Composite Index, which suffered its fourth straight drop, confirmed that it was in a bear market on March the 7th and has declined roughly 30% this year. The Volatility Index, known of course as the fear gauge, spiked to its highest level since May. And many analysts view the level as subdued and could mean more selling pressure is in store. Yet some are keeping the faith. This is a market that does not look like it's capitulating as much as it's frustrated, said Rob Hayworth, senior investment strategist at US Bank Wealth Management in Seattle. Even with some of the securities being thrown out, it's just not deep enough, violent enough to see that people have taken positions off. However, just remember this. There have been 17 bear or near bear markets since World War II, according to Ryan Dittrich, chief market strategist for LPL Financial. Generally speaking, the S&P 500 has fallen further once a bear market begins, and he said bear markets have on average lasted about a year, producing an average peak to trough decline of just around 30%. But beyond those averages, there is a lot of variability in the length and depth of past bear markets. The steepest fall, a peak-to-trough decline of nearly 57%, occurred in the 17 months that marked the 17-month bear market that accompanied the 2007 to 2009 financial crisis. The longest was a 48.2% drop that ran for nearly 21 months from 1973 to 74, and the shortest was a nearly 34% drop that took place in just over 23 trading sessions at the onset of the COVID-19 pandemic, and of course that sparked a global rout that bottomed out on March the 23rd, 2020. And cryptocurrency and blockchain-related stocks, including Riot Blockchain, Marathon Digital Holdings, and Coinbase Global, all plunged as Bitcoin slumped after major US cryptocurrency lending company Celsius Network froze withdrawals and transfers, citing extreme conditions. In fact, Bitcoin fell around 18% to below $23,000, plumbing its lowest since December 2020. And MicroStrategy, Block, and Coinbase Global were all down double digits. And by the way, the safe haven rally in gold wasn't that safe after the weekend. The yellow metals run up to 5-week highs last Friday was abruptly reversed on Monday amid risk aversion across markets on the eve of that third anticipated Federal Reserve rate hike. Front-month gold futures for August on New York's COMEX settled down $43.70 or 2.3% to $1,831. And that was the sharpest one-day drop on COMEX gold since May the 2nd, when it lost 2.5%. Gold's rundown coincided with the run-up in the dollar, which neared a fresh two-decade high of 104.96 against the basket of 6 major currencies. In fact, the only, quote, safe, unquote, risk, if any, appeared to be oil, with crude prices returning to the positive by lunch hour in New York after spending the morning in the red. The driver of all this negativity in the market centers around high inflation and high yields, which have been bad news for gold this year, said Craig Earlham, analyst on online trading platform Onya. The US dollar jumped to a fresh two-decade high against the basket of its peers as investors sought shelter in the safe haven currency amid the sell-off in risk assets. The dollar currency index, which tracks its performance against 6 other major currencies, was up 0.6% to 105.04 after scaling its highest since December 2002. And the plunge across equity markets and the US dollar's strength dragged the Australian dollar 1.9% lower to 69.24. The New Zealand dollar dropped 1.5% and the pound dropped 1.5%. And UBS has slashed its growth forecast for the Australian economy, reflecting its view that interest rates will now peak at 2.35% by the end of the year. The broker cut its forecast for real GDP in 2022 to 3.9% year on year, down from its previous prediction of 4.1%. And UBS also lowered its forecast for GDP in 2023 to 2.4%, down from 2.9%. Analysts said growth would slow particularly sharply in the second half of next year as declining consumption weighed on the economy. While we still expect spending growth to remain strong in the near term, underpinned by the reopening of the economy, the outlook over the next year now has more material headwinds, said George Tharanew, the broker's chief economist for Australia. But the chief investment officer of the country's largest pool of capital, Australian Super's Mark Delaney, said Australia is heading for a material slowdown as the global growth nears the end of its 13-year bear market. His forecast is backed by leading economists who expect a sharp slowdown in the economy from next year amid headwinds from rising interest rates and falling real wages. Mr. Delaney's predictions come amid market expectations the Reserve Bank will raise rates to 3.1% by the end of the year to tame soaring inflation, caused by a combination of global supply chain issues, the war in Ukraine, and demand-side pressures from Australia's tight labour market. The $261 billion mega fund is on track to post its first financial loss in 13 years, with Australian Super's balanced investment option down 0.83% in the financial year to June 9th. Mr. Delaney said global financial markets were navigating a difficult period characterised by short-term challenges owing to the end of COVID-19 stimulus and longer-term pressures from the end of the 13-year economic cycle. Well, to put it bluntly, here's the issue. Inflation is raging. Central banks need to lift interest rates to try and tame inflation, and yet market liquidity is going into reverse. And as markets fall, more market calls are required, meaning people need to liquidate assets to prop themselves up. This is now a very unstable situation. So the question now is, how long will central banks lift rates? Probably quite a long time because inflation is so embedded and entrenched. But what are the consequences? Well, certainly recession is on the cards. Higher mortgage repayments are on the cards. And therefore, we must expect markets to continue to fall. And as I said before, and I'll say again, I suspect September or October will be the point where we'll get a read on where the markets go from here. But the liquidity crisis is actually now probably the most critical issue to think about. And I discussed this with John Adams on our recent post on interests of the people. So go and check that out if you want more information about what's going on with regard to liquidity. We are now in a confirmed bear market, and I'm afraid if you expect any significant bounce in the short term, you're kidding yourself. The broader implications of this for the property sector going down, crypto going down, and in fact most other assets too, means there is really no hiding place. And in fact, at the moment, maybe cash is your friend, even if returns on cash are pretty limited. But if you hang on a bit, you may well find that term deposit rates continue to rise and returns therefore look a little better if they still remain below inflation. And it's worth noting that the ASX 200 opened nearly 5% down on Tuesday morning, obviously catching up from the news last week and also Monday in the US. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.